want to clean up a couple things that we were discussing with equity and debt financing here as we were going through. And the main thing when we were discussing debt financing was we know that a creditor might offer a certain amount of money to a firm, and in doing so they will get an interest rate as a percentage of the par value of that bond for a number of years or for a number of months until the maturity date. And in and of itself, you might choose to purchase that bond and hold on to that bond for the entirety of the life of the bond all the way through the maturity date. However, you might also choose to no longer want to hold that and sell it on the market. In fact, there is a very active secondary market for bond issuance. And so once that bond is issued, throughout the maturity date, you have the right as the creditor to sell that bond. And there's a market value of that bond. And we typically compare it to, this is where par value comes into place, we typically compare it to the par value of that bond. And so if it was originally on face value worth $1,000, and let's say you're going to purchase it sometime between year 3 and year 4, we know that you still have 2 more years of the interest rate payments, and then you also have the par value. You actually have the face value of that bond that you will receive as well. However, you might not have to pay $1,000 for it to get that right to those cash flows. You might have to pay less, you might have to pay a little bit more depending on the price of the bond. And that's really determined by the market conditions as well, by the demand for those bonds as well. We were also talking about what creates the interest rate for these bonds. How do we set the interest rate? Well, it's set on the open market, and there's really of many things that go into the coupon rate or the interest rate for a bond. There's 2 main things that dictate it, which is the default risk, the risk that the company or the state or the federal government might actually go under and not be able to pay out the rest of the bonds or pay you back the principal amount, and the time horizon as well. And that time horizon typically means that as you go out further into time, you would demand a higher interest rate as a creditor because of the uncertainty that is inherent with increased time horizon, that is just inherent with not getting that payment back until 5 years from now. So what I want to do is, let's take a case of the federal government, and the federal government has treasury bills. And so I've gone out to the treasury site, and we have T-bills or treasury notes, depending on the length of it, that are often referred to. And you can see that they publish all the information on these, and you can see we have treasury bills that extend from 1 month, that they have a maturity date from 1 month all the way out to 30 years from now. And I've taken all that information for 2013, for example, just so we've got a full year of data to look at. And I've got it here in this spreadsheet. So I took all this information and I've combined it into 3 charts here, just simply so that we can kind of summarize those 2 last points, that the default risk really matters, and that the time horizon matters as well when it comes to the interest rate. So here we're looking at the yield rates on the treasury notes, and you can see that this is by the maturity date. So this would be on the y-axis, we have the interest rate or the yield rate. So this would be 4.5% to 0.00%. And this is throughout time. So this is what those maturity dates would look like on that date. And if we're looking at this over time, we can see through 2013 that over time, it doesn't matter, the 30-year treasury bill always has a higher interest rate, always has a higher yield than the 10-year, for example, or the 7-year or the 5-year. Even down here to the 3-month, we can see that that's a very low interest rate. And so as the time horizon increases on the maturity date, we definitely see an increase in the interest rate that creditors demand to be able to take on that risk. There's increased risk. That being said, for the federal government, there is pretty low risk. In fact, we typically refer to T-bills or the federal treasury bills as, generally speaking, as risk-free, because when you take into there's almost no chance of default. And that's because the federal government can continue to raise taxes throughout time to pay off their debts, and they also have control of their money supply. And so it's really basically impossible, unless the government just chooses to go into debt on its own by doing something like not raising the debt ceiling, for example, that we would default on our loans, or that we would default on our bonds. And so as a result, we tend to have very low yield rates on our bonds. Another way of looking at this chart is a yield chart right down here, and you can see this as this middle chart. This is again on the y-axis the percentage yield, and then here we've got on the x-axis we have the maturity date. So this is organized by maturity date, and you can see what we get on this yield curve is really, and I've done this for different periods in time, and what I'm trying to show here is kind of the shift that we saw throughout 2013. So this blue line, for example, is on January 2nd, 2013, and you can see that a 1 month Treasury bill would have a very low yield rate all the way up to a 30-year Treasury note that would have almost about a 3%. And that extended all the way up here, right? Kind of this entire yield curve basically shifted throughout the summer and all the way up until, and I chose 10/15/2013 on purpose because that was the day that we ran up against the debt ceiling. And the debt ceiling is the statutory limit on the amount of debt that the federal government can take out. And at the time, I believe it was like $16.499 trillion or something of that nature. It's a specific amount of money that the federal government cannot exceed. And if it exceeds it, then it goes into kind of a technical default. It goes into a default of its own choosing. And there was a little bit of a risk that we were going to choose to default on our debts, that we were going to have to prioritize certain creditors over other creditors. And that's what we're seeing here as these rates increase. Some of that was being borne, but kind of the main way that you can see it is just right here on the 1 month Treasury bill. For the most part, that has a very low interest rate, and when we take into account the real terms, when we take into account inflation, it's almost worse than a savings account, right? It is a very safe store of money. There is almost no risk, and as a result, there is also almost no return at all on your cash. Or on your investment in the federal government. However, there's some reasons that you would take that for diversification and a number of other reasons on the finance side. What I'm trying to show here is that there was a spike in risk that was associated with that debt ceiling debate. And if I come down here to the third chart, that's what we're seeing here. I've isolated here on the 1 month Treasury bill here, and we can see this over time, and we can see that it is typically, again on the y-axis, this is percent. And so we are looking at 0.10% on the yield. These are incredibly low, almost a 0% yield, right? Almost no interest at all for the right to give the federal government money. And so we can see over time that this is mostly a very small amount, and then we saw a small spike right there around 10/15, around the middle of October 2013, and this was associated with the debt ceiling fight. And so I just do this to kind of highlight that two things, that these rates can move over time, both in the time horizon and the long time horizon for maturity date, but also in a day-to-day that there is market activity that allows individuals to sell those bonds, and that those bonds do respond, that there is a price for selling those bonds, and that they do respond to market conditions. That being said, even in a case where the Congress of the United States basically almost decides to default on its debts, there was still very little market. There's very little market pressure on the federal government or on the bond rates here. The bond market did not respond all that much to the prospect of the United States defaulting, because it's really still pretty unimaginable that the United States, even if it did choose to not increase its debt ceiling, that it would not actually default on its debts, because it's such a large government, we have such a large tax base that it's nearly impossible not to pay the creditors back for their lending. So just another way that we can look at the same information we were previously talking about, in this case from the federal government's standpoint itself.